Drukenmiller is wrong. Now, when I say that, Drukenmiller is the GOAT. This guy is amazing. He's one of the best investors of all time. So I have total respect for him. But I think he's wrong on one aspect of his portfolio. So let's go take a look at the 13F filings. All hedge funds have to file a 13F, and that updates their quarterly statements. If we go to Bloomberg, we can see that at the end of 2024, Drukenmiller had made some changes in his portfolio. Here's the allocation. We can see that he's got some large allocations here. If we compare that to the S&P 500 allocation, we can break that down. And here I've got this graph showing the tilts or the skews by the sectors. So we can see that the technology sector, you can see Drukenmiller is very underweight the technology sector. In the S&P 500, the technology sector is 32% of the S&P 500. That's almost 1/3. Drukenmiller is 14% below that, or 15% below that. So he's way underweight the technology sector. Drukenmiller, by the way, is he doesn't hug the index here at all. He makes some big bets. And I actually agree with that technology sector underweight position overall. His philosophy is very different, and that is that he believes to outlook 18 months into the future, and that's how investors should look at their investment portfolio, and it's done him extremely well over time. He's actually had 30 years of strong performance and never had a negative year in that 30 years, and outperformed the S&P 500. Absolutely incredible investor. If we take a look at a couple of the other weightings here, we got healthcare. Healthcare is typically 10% of the S&P 500, and Drukenmiller is actually got an 8% overweight in that sector, and that's quite a bit. And the healthcare sector has actually done quite well in the first quarter of 2025 so far. Now, if you look at the industrial sector is typically 8% of the S&P 500. And Drukenmiller has an overweighting of 7%. So he's got 7% more than the actual weighting in the S&P 500. That's the sector I want to focus on. And then specifically, if we take a look at the changes Drukenmiller made in Q4 2024, he took on and increased positions in the airline stocks. So the airline stocks were on fire in 2024, and they did extremely well, that whole sector. But I think this could be a mistake for 2025. And if we take a look at the technicals for the airline stocks, first of all, we can see the strong outperformance relative to the S&P 500 in the second half of the year, and also on an absolute basis. And we can start to see that the sector is actually starting to roll over now, and underperform the S&P 500. So it's broken its upward trend line on an absolute basis, and it's starting to underperform the S&P 500, which is not a good sign. And if we look at the price momentum with using the RSI, we can see here that the price momentum has been declining. So the technicals right now aren't very favorable for the airline sector. Now, if we look at the seasonality for the airline sector, and this is, I'm going to put a plug in here for my website, alphamountain.com. And if you go to that website, you can see on the last tab here, I just added this new tab called Graphs. And I started posting some of the sectors and the markets, the seasonality. And if I use it here and talk about it, I'll try and post it on there as well. And eventually I'll build this up over time. And there are a few sectors up there right now. I've added the airline sector here. And then click on the airlines. You can see that, oops, I just slipped here a little bit. I'm actually in Bronte Provincial Park here today. And absolutely gorgeous day. It's very warm. And you can see here, I'd love to show you here a little bit of the trail here. We've had a bitterly cold winter this winter, and last weekend we got 60 centimeters of snow. I was actually out at the park here and laid down 20 kilometers of cross-country ski track. Yeah, that did me in a little bit, but a lot of fun. Anyhow, we click on the airlines tab here. we can see the basic report for seasonality for the airlines here. Relative to the S&P 500, the airlines typically start to underperform mid-April. And that's coming up shortly. We're only really a month and a half away from that. And if we look at the monthly basis here, we can see the overall trend for the airline sector on an average basis and median basis starts to decline into the summer months. And if we look at the last 10 years, and we pull up this chart here, look at this blue line, we can see the average for the last 10 years for the airline sector on an absolute basis. It has peaked on average in late February 22nd. So it's actually been earlier than the long-term average since 1990. And seasonality, yes, sometimes it is uncannily to the day or very close, but it's an average, and it gives you the average trend. Sometimes it starts a little bit earlier, sometimes a little bit later. But the last few years, it's been starting a little bit early, right around this time of year, of weakness for the airline sector. So I can't say that's going to happen again, but we are starting to see some underperformance for this sector on a technical basis. Now, so why did the airline sector do so well in 2024? It goes back to COVID. Yes, back to COVID. And I've talked about this in the past as far as the money that was given out during COVID and how it was distributed. The lower income groups got very little money, spent it really quickly, and have suffered from inflation at a much higher rate than higher income groups. Now, the higher income groups, in particular, the business owners, got huge amounts of money through their businesses. It was actually done in I'd say a reckless fashion about how much money was distributed and etc. And so they got way more money than they needed at the higher income group on average. And that money was counted as excess savings. So the lower income groups, and I've talked about this in the past and done videos on it, the lower income groups spent their money quickly and now are really suffering and finding it difficult to get along. The higher income groups, on the other hand, received huge amounts of money, and it was easy come, easy go. So they've been spending money on air travel. But according to the Federal Reserve San Francisco report, now they don't break it down in this report by income group. In late 2024, they put out the report showing that excess savings on average has declined. It's actually negative from COVID. In other words, all the COVID money is spent on average and then some. So I think we're at that point now where even the higher income groups are suffering a little bit with not having enough money on a go-forward basis. We've been at that point, I think, for a little bit here, although the spending is still being maintained. So 2025, we're going to see perhaps a cutback, I think, on some of the discretionary budgets, higher ticket items. Now, the airlines have put forward some different results. American Airlines recently, with their earnings, came out and said that they were lowering their guidance on a go-forward basis. Now, they also did suffer because they made a strategic error in increasing prices for business class and forcing the passengers to other airlines. But they did lower the guidance for the future. And in Canada, you look at Air Canada, they also lowered their guidance as well on a go-forward basis, and their stock has come back down. So if we take a look at the fundamentals for the industry, there could be a little bit of trouble. Now, I think there's more to it than just the airline sector now looking like it's going to roll over. If we look at the actual market and what's going on right now, I want to show you this graph here. So this graph has three different lines on here. One line represents the selection for the defensive sectors. The other line represents the, on average, equally weighted average for the cyclical sectors. And the other line represents the technology, or I should say the growth sectors of the market, including technology. And if we take a look at the performance of these three relative to the S&P 500, so when the line's rising, it's outperforming the S&P 500. When it's going down, this grouping is underperforming. Let's go back to December and take a look. We can see that the growth sectors actually performed very well compared to the S&P 500. And we saw the defensives underperform. We saw the cyclicals underperform. Everybody poured into the growth sectors of the market, in particular, the communications sector. 2025, what have we seen? We've seen the growth sectors pull back a bit, and we've seen the material sector, or the cyclical sectors, actually improve a bit. But the big thing we should watch out for here is we're seeing the defensive sectors performing quite well, and we've seen that uptrend relative to the S&P 500 year to date. Now, this is not a good sign, because that tells us that yes, there can be some seasonality for some of the defensive sectors at this time of year, but it tells us on average in this bigger period of time, in a favorable 6-month period for the stock market, when the defensives are outperforming, then investors want to stay in the market, which is good news, but they're starting to become very cautious on the market. And so they're not piling out of the market, they're staying in the market, but they say, look, I want to be in defensive sectors at this time. What does that mean? It means the stock market can actually do quite well. And at the same time, it's being hollowed out from underneath itself, because you don't find the growth sectors doing well or the cyclical sectors doing well, and it becomes susceptible to a little bit of a correction. And that's where we're at now. The stock market can continue to do higher, to move higher, powered by the defensive sectors, but it is susceptible right now to pull back at this time. Now, if we take a look at year to date for the sectors of the market, we can see here that the defensive sectors have all outperformed the S&P 500, the consumer staples, healthcare sector, and the utility sector. Now, the utility sector actually has a strong seasonal period coming up shortly as well, something to watch out for. If we take a look at the performance of the stock market last week, the S&P 500 was lower last week, but all the defensive sectors were positive. So we've seen that continuation trend. Is it going to continue? Perhaps. Maybe we see a little bit of a bounce back in the market. On a seasonal basis for the stock market at this time of year, as I mentioned in previous videos, we find that the S&P 500 tends to be softer in the month of February. And right now we're just slightly positive for the month to date. And the weaker part for the stock market in February is the last 2 weeks. So we could see some further softness in the market overall as well. So yes, there could be some softness, but it doesn't mean the stock market's going to crash. And March and April tend to be fairly strong months on a seasonal basis, particularly April. So we could see the stock market actually do quite well at that time if we do see a pullback coming up. But right now we do see that defensive trend taking place with investors moving into the defensive sectors of the market. This week, we do see the NVIDIA coming out with its earnings on Wednesday after the bell, and that's going to be interesting. They typically have outperformed their earnings, beat their expectations, and really cheered the market and really helped investors become quite positive overall on the stock market. That could actually drive the market higher as well. That would be good news, of course. It's going to be an interesting week. Thank you very much for joining me today.